Imagine this. You bought an investment property in one of America's hottest migration cities. You expected steady rent increases and strong cash flow for your retirement years. Instead, in 2026, rents in Austin have plunged as much as 18% from their peak. Phoenix is down over 15%, and Nashville is following the same painful path. Landlords who rushed in during the pandemic boom are now offering 2 months free, slashing prices and watching their monthly income evaporate. What was sold as the future of American growth has quietly become a cash flow nightmare. Today, we're pulling back the curtain on the 2026 rent collapse that almost no one saw coming, and why it's hitting Austin, Phoenix, and Nashville hardest. Stick around because the implications go far beyond these three cities. For years, the story was simple. Remote workers, retirees, and companies fled high-tax, high-cost states like California and New York for the Sun Belt. Austin, Phoenix, and Nashville became magnets, promising jobs, lower taxes, sunshine, and space. Migration surged, demand for housing exploded, rents and home prices skyrocketed. Investors poured billions into multifamily apartments, betting the boom would last. But something shifted. Between 2023 and 2025, developers delivered tens of thousands of new units across these markets. Supply flooded in faster than new residents could absorb it. By early 2026, the national median asking rent hit a 4-year low. In the Sun Belt, the relief for renters became a reckoning for landlords. Vacancy rates climbed well above national averages. Concessions, free rent, waived fees became the new normal just to fill units. Start with Austin, the epicenter of the collapse. Median asking rents peaked near $1,659 in late 2022. As of February 2026, they've fallen to about $1,357, an 18.2% drop, the largest in the country. That's roughly $300 less per month for many units. The city added over 120,000 housing units since 2015, far outpacing population growth in recent years. Even with continued in-migration, the surge in luxury and Class A apartments left older buildings cutting rents by up to 11%. Landlords in suburban complexes now compete aggressively with concessions. One local investor recently told analysts he's covering negative cash flow out of pocket while waiting for the market to absorb the excess. Phoenix tells a similar story. Rents peaked at $1,690 in mid-2022 and have dropped 15.6% to around $1,427 by early 2026, a monthly loss of over $260 for typical units. The metro has seen 41 consecutive months of year-over-year declines. Massive apartment construction in the suburbs, combined with moderating migration, pushed vacancy rates higher. Some properties now offer 1 to 2 months free just to sign leases. Retirees and remote workers who moved here for affordability are benefiting, but property owners counting on steady 5 to 7% annual increases are watching their returns vanish. Nashville rounds out the trio. Rents have fallen about 13.9% from their 2023 peak, sitting near $1,457 in February 2026, 31 straight months of softness. The entertainment and tech influx brought thousands, but developers responded with thousands of new units. Suburban areas like Mount Juliet now show elevated vacancies. Landlords report longer lease-up times and heavier incentives. What looked like unstoppable growth has turned into a waiting game. The numbers are sobering. Across these markets, many investors who bought at peak prices now face negative or break-even cash flow after expenses, taxes, and maintenance. For retirees relying on rental income to supplement Social Security or pensions, this creates quiet stress. Some are selling at a loss or refinancing under pressure. On the flip side, renters finally have leverage, negotiating lower rates and better terms after years of rapid increases. But the broader economy feels the ripple. Slower construction starts in 2026 mean fewer jobs in building trades, and softening property values in oversupplied suburbs could pressure local tax bases. Looking ahead, new apartment deliveries are projected to slow sharply in 2026 and 2027 as the building boom cools. Some analysts expect rents to flatten or even tick up modestly once the excess supply is absorbed. Yet risks remain. If migration slows further due to economic uncertainty, or if remote work trends shift again, these markets could stay soft longer than expected. Other fast-growing cities watching the same pattern, overbuilding followed by correction, may face similar landlord pressures in the coming years. The 2026 rent collapse isn't a national housing crash, but it's a clear warning. Rapid growth without balanced supply can create painful corrections that hurt property owners most. America's housing story continues to unfold in unexpected ways. The Sun Belt migration that reshaped the country brought real relief for many renters, but it also delivered hidden risks for those who bet heavily on endless demand. Watch these markets closely in the months ahead, because when supply and migration fall out of balance, the consequences can linger far longer than anyone predicts. If you found this breakdown useful, let us know in the comments which city or risk you want explored next. Thanks for watching, and stay informed.